This is big picture earnings analysis. Alphabet, Q4 2025. Revenues up 18% to $113.8 billion. EPS $2.82.
A clean beat.
A beat across the board. But the guidance is the real headline here.
Oh, absolutely.
Massive infrastructure spending for 2026. Let's get right into it.
It was a solid quarter, no doubt. But you're right. That guidance is what's going to dictate the story for the next, 12 months. We're looking at a huge shift in capital allocation.
Exactly. And if you're holding GOG, you saw the numbers, but we really need to unpack what they mean for your portfolio.
Right.
Let's just set the context first with the top line. Annual revenue crossed $400 billion for the first time.
I mean, that is just a staggering number. $400 billion.
It's hard to comprehend.
It really is. To put that in perspective for you, that's roughly the GDP of a country like Denmark for one company.
And it's still growing at 18%.
Which just defies the law of large numbers. Usually at that scale, you're slowing down, you're in the single digits. Alphabet is somehow accelerating.
And they comfortably beat the street's expectation of about $111 billion. EPS came in at $2.82, which was a surprise of almost 7%.
Yeah.
But the thing that caught my eye, and I'm sure yours too, was the market reaction.
Yeah.
It was just polite.
Polite is a good word for it. It wasn't a party.
No. The stock was up maybe 1% in after-hours trading.
And that is the CapEx hangover in action.
Right.
The market loves the cash coming in, but it's terrified of the cash that's about to go out.
Which brings us to the number that everyone is talking about, the 2026 guidance for capital expenditure.
The sticker shock number.
The CFO, Anand Ashkenazi, guided for a range of $175 to $185 billion.
Let's just pause on that. $185 billion.
In 1 year.
In 1 year.
I mean, it's an astronomical amount of money. And I think a lot of retail investors, they look at that and they think, is this just empire building? Is this waste?
It's a valid fear.
Because historically, when tech companies spend like this, returns on invested capital tend to drop off a cliff.
They do. But Ashkenazi did something really smart on the call. She didn't just throw out the number, she gave the split.
The 60-40 split.
And that breakdown is absolutely critical for understanding the risk here. 60% on technical infrastructure, which means servers, and 40% on data centers and networking.
So buildings and fiber.
Exactly. And that distinction is everything. That 40%, the buildings, the power grids, those are long-duration assets.
Right. Real estate.
It's real estate. It holds value. You build a data center, it's good for 30 years. But the 60%, the servers, that's where the danger is.
Because chips depreciate faster than a new car off the lot.
Oh, much faster. We're in a cycle where silicon improves exponentially, every 18 months or so. So if Alphabet is spending nearly $110 billion just on chips in 2026...
It's a huge bet.
A massive bet. They are betting they can monetize that compute power immediately before the next generation of chips makes it obsolete.
So did Sundar Pichai address that obsolescence risk? Because if I'm a shareholder, I'm thinking, why buy now? Why not just wait a year?
He was very direct about it. He used the phrase supply constrained.
Okay.
He's basically saying, we're not spending this because we want to. We're spending it because we have to. They have customers, both internal and external, screaming for capacity that they physically do not have.
So demand is just outpacing their ability to supply it right now.
By a wide margin. And Pichai's logic here is that the risk of underinvesting is fatal. If you don't have the compute, you miss the entire platform shift. You become Yahoo.
Okay.
The risk of overinvesting is just, your margins take a hit for a few quarters. One kills the company, the other just hurts the P&L for a bit.
So it's a defensive moat. They're just digging a trench and filling it with GPUs.
That's a perfect way to put it. You can write code in a garage, but you can't deploy a $185 billion server fleet from a garage. This cements their position.
So it's not just about buying NVIDIA chips then?
No, and that's the other layer here we have to talk about. They mentioned integrating the Vera Rubin platform from NVIDIA, sure, but they really emphasize their internal silicon.
You're talking about Ironwood.
Yeah.
Their TPUs.
Yes, the tensor processing units. And this matters to you as an investor because of margins.
How so?
When you buy from NVIDIA, you're paying NVIDIA's margin. When you build your own chip, like Ironwood, your cost per unit of compute is just significantly lower.
Got it.
So they can run their own Empire Search, YouTube, Gemini training on their own custom, cheaper silicon. They buy NVIDIA for the cloud customers who demand it, but they run Google on Ironwood.
It's cost control disguised as R&D.
Precisely.
Okay, so they're spending the GDP of Hungary on servers. Let's talk about the business that's justifying that spend, Google Cloud.
The star performer of the quarter. This was the moment cloud went from, a nice growth story to a legitimate profit engine.
The numbers are wild.
Yeah.
Revenue up 48% to $17.7 billion.
For a business unit of that size to grow almost 50% it's just rare.
It is. But the operating income, that's the aha moment for me.
It doubled to $5.3 billion. And the margin.
The margin expansion.
Operating margin went from 17.5% a year ago to 30.1% this quarter.
That's a massive jump. Usually you fight for 100 basis points. They jumped over 1,200.
Oh, it tells you the sales mix is shifting. If you're just renting out servers, that's a low-margin commodity business.
Right.
A jump to 30% margins means they are selling the high-value stuff on top.
Okay.
The AI platform, the security tools, the analytics.
So they're not just the landlord anymore. They're the architect and the security guard, too.
Exactly. And Patai dropped a stat to prove it. He said 95% of the top 20 SaaS companies and 80% of the top 100 are using Gemini.
So we're talking about Salesforce, Shopify.
Right. These companies aren't just hosting on Google. They're building their own AI features using Google's models, and that creates immense stickiness.
And speaking of stickiness, we have to mention the partnership news, the one that probably made a few executives at Microsoft spill their coffee.
Apple.
Sundar confirmed that Apple is using Google Cloud as their preferred cloud provider to develop Apple's own foundation models.
This is huge. I mean, Apple is famously secretive. They love to own every single part of the stack.
Total vertical integration.
For them to publicly lean on Google Cloud for something this core to their future is a massive, massive validation.
It's basically Apple saying, we have all the money in the world, and we still think Google's infrastructure is better than what we can build ourselves right now.
That's it. It signals that Google's AI factory is operating at a level that even its biggest competitors have to rent access to.
So cloud is the growth engine. It's profitable. It has Apple. Let's turn to the cash cow, though, search. Because for 2 years, the bear case has been AI kills search.
A cannibalization narrative.
Right. If I get the answer from a chatbot, I don't click the link. And if I don't click the link, Google makes $0. That's the whole fear.
And looking at these numbers, that fear seems, well, misplaced.
Search and other revenue grew 17% to $63.1 billion.
It's accelerating growth in their most mature business.
So is that narrative just dead then?
I wouldn't say dead, but it's evolving. What we're seeing is a behavioral shift. It's not replacement, it's expansion.
What do you mean by that?
Management said that queries in what they call AI mode are now 3 times longer than traditional searches.
3 times. So instead of weather Paris, I'm typing, what is the weather in Paris next week, and what should I pack for a business dinner?
Exactly. And you're asking follow-up questions. It's a conversation.
I'll play devil's advocate. How do you monetize a conversation? If I get the answer about what to pack, I didn't click an ad.
That is the billion-dollar question. And they're testing ads within the AI response. But the real bull case is about commercial intent. Meaning that a long query, like plan a trip to Paris, is infinitely more valuable than weather Paris.
Because you can sell flights, hotels, dinner reservations.
Exactly. The argument is that AI is unlocking these more complex questions, which actually carry much higher ad premiums. And the data shows it's becoming a habit daily AI mode queries per user doubled in the US.
So they're training us to be better, more complex searchers.
And they're training us for the next phase, which is where things get really sci-fi. We need to talk about agentic AI.
The buzzword of the quarter.
It is, but for good reason. This is where you see the long-term return on that $185 billion investment.
Okay, so define it for us. What's the difference between the AI we have now and agentic AI?
Think of it like a tool versus a contractor. A chatbot is a tool. It gives you a recipe. An agent is a contractor. It goes to the grocery store and buys the ingredients for you.
It's the transaction layer.
Exactly. They are moving from helping you find things to helping you do things. They even introduced this universal commerce protocol.
Sounds very official.
It's a strategic play. They want to create a standard language for how AI agents talk to online stores, if they can set that standard.
They become the browser for the entire agent economy.
Precisely. And this isn't just a theory. They mentioned a platform called Google Anti-Gravity, where agents are already executing software tasks. It has 1.5 million weekly active users.
Wow. But speaking of developers,
Yeah.
there was one stat on the call that to me, is the most important number for the future of the company's margins.
I know exactly which one you're talking about.
Sundar said that 50% of Google's own code is now written by AI agents.
Then reviewed by engineers. We have to add that little caveat. But yes, 50%.
That is just, it's wild. Half the code powering Google was generated by the machine itself.
And it explains their velocity. If you can double the output of every engineer by having an AI do the grunt work, you can iterate so much faster.
But it also ties back to that CapEx versus OpEx debate we were having, doesn't it?
It absolutely does. Think about it. Traditionally, if you want more code, you hire more people. That's operating expense OpEx.
Salaries, benefits.
Exactly. Now, if you want more code, you buy more servers to run the AI that writes the code. That's capital expense CapEx.
So are they essentially prepaying for a digital workforce?
That's the provocative theory, that this $185 billion isn't just for external customers, it's buying the digital employees that will build the next version of Google.
And you don't pay health insurance to a server rack.
The long-term margin potential is unlike anything we've ever seen. It is the ultimate leverage.
A digital workforce paid for in silicon.
It's a fascinating concept. Let's round out the portfolio with the other two killers, Waymo and YouTube. Waymo has been a science project for a decade. Is it finally a business? It's crossing the chasm. They're doing 400,000 paid rides per week now.
That's a real number. That's not a pilot program.
No, that's a real transportation network. 20 million autonomous trips total. They're expanding to Miami, the UK, Japan. But investors need to see this. There was a $2.1 billion charge this quarter related to Waymo.
Well, I saw that in the R&D line. Was that an operating loss?
No. And this is where accounting gets weird. It was a charge related to an increase in Waymo's valuation.
Wait, so because Waymo became more valuable, it cost Alphabet more money on paper?
Exactly. It's a success tax because of how they structure the stock-based compensation for Waymo employees. So if you strip that out, the EPS beat would have been even bigger.
Good context. Okay, and finally, the living room, YouTube.
YouTube is transitioning from an ad platform to a subscription giant.
Right.
The subscription platforms and devices category brought in $13.6 billion, up 17%. That's all YouTube Premium and YouTube TV.
They've won the living room.
Nielsen data confirms it. They are the #1 streamer in the U.S., ahead of Netflix. With NFL Sunday Ticket, they have effectively replaced the cable box for a huge demographic.
Okay, so let's zoom out, Peeker. Massive beat on revenue and earnings. Cloud is exploding, search is growing, Waymo and YouTube are scaling.
The fundamentals are incredibly strong. The business is firing on all cylinders.
We have that $185 billion elephant in the room.
The gamble.
So how should you, the listener, think about this? Is this a buy, a hold, or a wait and see?
Well, you have to look at the track record. They poured billions into cloud when everyone said AWS had already won. Now cloud is a nearly $20 billion a quarter business with 30% margins.
They've proven they can turn that infrastructure spend into profit.
I think they've earned the benefit of the doubt. But you have to be vigilant. You have to watch those margins. They need to prove this AI spend generates the same kind of returns they just showed in cloud.
It's high-stakes poker, but they have the biggest stack of chips at the table.
Literally and figuratively.
We'll leave it there. A massive quarter, a massive forecast, and a company that is, well, literally rewriting its own code. Thanks for listening to this earnings breakdown. Keep watching the CapEx.
And keep an eye on those margins.